While we expect global growth to remain lackluster, we think the worst is probably over for most emerging markets. Chang Liu, Capital Economics. Well, China's inflation rate lost speed for the third consecutive month and so falls further away from the government's 3% ceiling this year. With this in mind, could this nudge the PBOC to seriously consider easing?
Well, the fall in headline inflation certainly gives the PBOC more room if they wish to do so. But actually, the fall in inflation this month was almost entirely, or is entirely, due to a fall in food price inflation, which is in turn dragged down by a fall in pork price inflation. So that fall in the headline rate actually masks a pickup in broader price pressures. Non-food inflation picked up to 1.4% in July, which is the highest since August 2014. And looking ahead, we actually expect consumer price inflation to edge up again in coming months. The low base provided by the sharp drop in oil prices in the second half of 2015 should boost energy price inflation, and flooding in large parts of China over the last 2-3 months would likely lead to an increase in food price inflation as well. So we think inflation would remain in the policymakers' comfort zone for this year and next. But it certainly isn't going to fall any further, we don't think, or much further.
Okay, well, China's imports and exports fell by significantly more than expected in July, which has revived the market's concerns over both China's as well as the global economic outlook. To what extent, then, do you believe that the worst is over for China's trade industry in 2016?
Well, the trade numbers were certainly weaker than we expected, but despite the disappointing data, we don't really think it's a reason for major concern about immediate prospects in China. On the export side, external demand is likely to remain subdued. But while we expect global growth to remain lackluster, we think the worst is probably over for most emerging markets. And in any case, I think China is less reliant now on export demand than it used to be. On the import side, we actually think the continued feed-through from stronger credit growth due to monetary easing will provide some support into domestic demand in the second half of this year. And the weak base for comparison from the falling commodity prices in the second half of 2015 would also boost import growth. So that should probably return to positive territory by the end of the year.
And lastly, which other key indicators will you be keeping a close eye on that will likely have a significant impact on China's economic sentiment?
Aside from the inflation data and the trade data that we already received yesterday and today, we had the FX numbers on Sunday, which the FX data has received quite a lot of attention because of all the focus on renminbi and capital outflows. And the latest data actually show that China's FX reserves were stable and that the PBOC was likely able to reduce its interventions because of stable outflows. So that's positive. For the rest of this week, we have activity data and sales data on Friday, and lending data should also arrive before the end of this week. So on those things, we think investment growth probably remains stable. Fiscal spending probably provided a boost to investment, but a strong base from last year would likely keep growth stable. We're hopeful that industrial production would likely pick up due to the feed-through of past policy easing, and retail sales growth should remain strong as well.
Thank you, Chang. Be sure to check back with the Dukascopy TV team for more updates throughout the week. I'm Sam Meredith, and see you next time.